Good morning, everyone. Welcome to this update for global stocks and the run that we're probably going to get into Christmas now, which normally happens November, December, normally pretty solid. Looks like it's well set and ready to go. So look, every week there's lots of things happening. We've seen a staggeringly strong rally over the last couple of weeks. So let's get in and have a look at the action from last week. First of all, the American index only finished higher by 4 points, but as you'll see, if we look over the last 2 or 3 weeks, the rally really has been extraordinarily strong. And look, the volume was lacking a little bit of power until last week, but there's no doubt that this has been a very, very impressive rally. Now, the breadth has also been lagging. Now, what I mean by breadth is that the index has been carried up by a lot of large cap stocks, and in America they have ETFs or sectors which rate the sector based on uh, the actual equal allocation of stocks rather than based on market capitalization. The S&P index is based on market capitalization, so therefore if the really big stocks are advancing, then the index can go up. But some of the smaller stocks might be lagging, and that certainly has been the case to a degree. But that breadth is starting to improve now. Now, also the small caps, the Russell 2000, have also lagged, but again, that's pretty normal, and also is showing signs that it could be reversing. And this again is coming into the strongest time of the year for the Russell 2000 stocks. Now, for the S&P, it's been the best October in 4 years since 2011, and it's been the sixth best October ever on record. So that's certainly a very good positive sign for the next 6 months. The Nasdaq has been the strongest of the three main indices, the S&P, the Nasdaq, and the Dow. And again, that's a very good indicator for the market. And we've now just shifted to 53% of New York Stock Exchange stocks are now in official uptrend. Now, in July and August, that hit a low of 30%, so only 30% of stocks were in uptrends. But now we've moved back to 53. So you can see that the momentum of the market is definitely turning around. Another positive point for stocks is that there's been some selling in bonds. So yields have gone higher, which means bond prices have gone lower. Bond prices are going lower because people are moving money out of bonds and they're putting the money back into the stock market. So again, another vote of confidence. And I can add another one to that too, and that's the speed with which the VIX index has fallen below 20. It's really quite extraordinary that the fear and the desire to have put option insurance in the market just disappeared so quickly. So that really raises the question: why did we get the August mini crash at all? Well, if there wasn't a fundamental reason for it, and clearly the fear that was around and then went away so quickly, why did it occur in the first place? Now, there's no question that the trigger for that very, very sharp 3-day collapse in late August was when the Chinese devalued their yuan, and that then set up a whole lot of what ifs, and so traders decided to pull back, take a different position. That was all amplified by the computer programs that control so much of the market these days, and hence the massive 3-day fall that we got. But look, 2015 action is really, there's nothing mystical about it. It's simply about markets looking forward. So let's have a look at what I mean by that. We'll have a look at the S&P overall as well. So just look at the recent action. So you can see from the low on the 29th of September, the rally back to this area here, just short of 2100 and only about 2% from the all-time highs, has just been quite amazing. But if we just pan back and look at 2015 in total, then this period, I'll just mark it with a triangular box. This period here through to here was really a period where the market was uncertain. So stock markets are not, the price of the stock market is not reflecting what is currently happening now. The price of the stock market is always looking forward and anticipating what the prices should be if certain events actually play out as expected. So it's a very much a forward-looking mechanism. So the fact that the market went sideways in this period from January to the end of July indicates that people were uncertain. They didn't know whether the market should go up or down. They didn't know whether the economic conditions in America were going to get better or worse. And so we just had this grinding sideways movement that was really quite tight. Now, as I said, then at the end of August, the Chinese devalued the yuan. That was the trigger. We had these massive 3-day or 4-day collapse in the market, which was really a little bit of a mini crash. And so the next period, which I'll highlight, so this period in here is really indicating tremendous concern and fear in the market about what that Chinese devaluation might actually do to the global economy. But then you can see this amazing rally, which is then the third part, which again is the market. So people have got over this second phase here. They've now realised that what China did is not that big a deal. That the American economy it's now starting to be anticipated that the American economy is doing better, and so the market has said, well, okay, we shouldn't have had this fall. We better get quick smart. We better get back to where we were, and so that's really what's driven the stock markets over the last couple of months. So if you're an investor with a longer term view, then you've just got to understand how stock markets actually work, because during this period, and I've been saying this all the way through, that there was really no requirement from a fundamental point of view for longer term investors to make any change. If you're a shorter term trader, then yes, advantageous to free up some capital so that you can take advantage, protect some profit, take advantage of some bargains that might emerge. But as a longer term investor, then you didn't really need to do a lot, because as I've said over and over and over again, there is no fundamental basis for a bear market. There's never been a bear market without an economic recession, and quite clearly that's proven to be the case again this time. So that's the S&P index. We'll just look at this on a monthly. So we've been looking at this monthly chart now for some time. We've looked at the August, September, and October period here in 2011, and it's virtually a carbon copy this time round. You can see it's almost identical. Let's just have a quick look at the NASDAQ. So the NASDAQ index is basically already back at its all-time highs. So the NASDAQ's back to its all-time highs, the S&P about 2% off. But let's look at the Russell 2000. Now, this is on a weekly chart. Now, it just hasn't got anywhere near back to its all-time highs. But as I said at the start, not unusual, because the small caps do tend to be pretty soft during the July through to September into October period, traditionally. Doesn't happen exactly that way every year, but most years that's how it works. But having said that, November, December, and into January is traditionally, and again, no guarantees of what will happen this year, but traditionally November to January is a very strong period for the smaller cap part of the market. So I really do expect to see some catch up in the next few weeks. It really should be starting pretty much now. Now, the other chart that I'll highlight is the VIX index, and you can just see we had this massive spike up here when the Chinese did what they did. The VIX got up to nearly 40, which is pretty high. But then it's the speed with which it came back down again. We had one little blip towards the end of September that lasted about 4 or 5 days, and then the VIX just absolutely collapsed back below 20, and in fact got below 15. Now, if there's any level of fear in the market or concern for a bear market, then the VIX just would not be doing this. And this is the point that a lot of the doom and gloom and fear mongers have been painting. They've been trying to scare you into the fact that there's a bear market just so that they can create headlines for themselves. But all they needed to do was to look at two things to know that a bear market was never going to happen. One is the fact that America was not in economic recession. And the second one is that with the VIX doing this, how in heaven's name can you have a bear market when the VIX is doing what it's doing? So, you just got to bear in mind when you're reading a lot of these headlines, what the motivations are of the people who are actually writing them. A lot of them are just they're just headline seekers for their own particular vested interests. Okay, just one final couple of things on the US stocks. The state of the US economy is actually not that bad. It's not that great compared to some other times in their history, but compared to just about everything else around the world at the moment, America's in okay shape. And the Fed statement through the week actually provided more confidence that the American economy is going okay, because they certainly put a rate hike in December back on the agenda. Now, given the way they've behaved over the last 4 or 5 years, they're hardly going to do that if they thought that the American economy was in danger of slipping into recession. So the Fed statement certainly provided confidence in what their economy is doing. So just a bit of navel gazing on what sectors should outperform under these sort of circumstances. Economically sensitive stocks should do well, such as consumer discretionary stocks. They've been doing okay. There's been nothing wrong with consumer discretionary stocks, but they might even get a bit of a boost. And of course, technology has done really well. The Nasdaq index and a lot of those heavy technology stocks have done extremely well. We saw great reports from Microsoft, Google, and Amazon. All came out with great reports and jumped substantially. Turning now to the Australian market, the Australian dollar just remains in the 69 to 74 cent range. All the drivers, as I've been saying, are still to the downside. I would expect to see the Australian dollar down below 70 by the end of the year, and possibly well down into the 60s during next year. I don't think anything there has changed at all. Basically, ours is a commodity currency. It's going to follow where commodity prices go, and it's just nigh on impossible to see a major turnaround in commodity prices. Again, there are plenty of people telling you that oil's about to turn around and iron ore's about to turn around, but if you look at the supply and demand situation and you look at the realities of what's going on with those sectors, it's hard to envisage. The ASX 200 index was down by 112 points for the week, and that is, as usual, led largely by banks and also by commodity prices. So the major miners were off as well. So still, a relatively somber tale in the Australian market. Gold was lower by $23 on the week. So that was the US dollar getting a little bit stronger. And following the trends in the gold stocks is still the best forward indicator. Now, I've been talking about this for many years. If you want to know where gold's going, then keep an eye on gold stocks, because they'll probably give you a 2 to 4 week window. And as I've been saying repeatedly in recent weeks, the gold stocks were just not confirming a breakout in gold, and so it's been. And I can only wonder how much money people are losing by following the pundits who are telling you that now is the time to get back into gold stocks. Finally, we're on the verge of a new bull market in gold. apart from the fact they've been saying that for nearly 2 years, there really still is no signs, as you'll see from the charts in just a minute. So let's look first of all at the Aussie index, the ASX 200. Again, as I've said many times, I don't believe it tells us very much. It just really tells us what the banks are doing. So you may as well just look at the finance index, to be honest, and cut out all the rest of the noise. So this was the Aussie, obviously down last week. Hard to say what it'll do on Monday. Possibly not very much, to be honest. There wasn't much movement overseas. So turning now to gold. This is gold on a daily basis. You can see it was down in 4 of the last 5 sessions. And if we look at that on a weekly chart, there's been absolutely no change in the trend in gold at all. I just don't understand where this excitement about a new bull market in gold is coming from. You look at that chart, and I can't get excited about anything there at all. Let's just look at the gold stock index. This is the HUI index. I'll just pan back and take a broader look. You can see it's clearly still in downtrend. The red moving average line is still in downtrend. The price of the index is still below the moving average. We got a slightly higher peak, but we're almost immediately back down under this peak level again. So there's just nothing changed. It's business as usual for the gold market, I'm afraid. So for me, whether it's gold or whether it's stocks or whatever it is, it's really a folly to try and pick the bottom or to try and be the first one into a new bull market. Much, much better to let the bull market actually start to develop. Wait for the first little rise, and then a pullback, and then some stability before it moves higher. Then the odds are very much in your favor. So let the market show you that a new uptrend is about to start. It's just trying to pick the bottom and get as close to the bottom as you can is really a fool's game in my view. Now, copper dropped a bit, so this is really all just currency related stuff. Copper was down to 232 with the US dollar going a bit higher. Crude oil did bounce back 6% on Thursday, and I'm still shaking my head what that's all about, because the fundamentals would defy that. And from my perspective, crude oil remains stuck in a range between 42 and 50. So again, as with gold stocks, I would be very, very hesitant to jump into this developing theme, which seems to be, now's the time to buy energy stocks. I think it's still far too dangerous, far too early for that. I would rather pay 10% more and have a higher degree of confidence that that energy stocks were really starting to go into a new uptrend than I would by trying to pick the bottom. We've seen with gold has been it's been 4 years since the peak in gold, and people have been calling the bottom in that market for probably 2.5 of those years. The same thing could happen with crude oil and the energy market. There's the spot copper chart, so really nothing has changed much there. And to wrap it all up, clearly the correction is complete. Earnings season in the US has been solid enough for the fundamentals to now be the driver. That was the same comment I made last week, and I wanted to reiterate it because it's just such an important concept. Good investing is about simple things that make common sense. And if earnings season is solid enough to remove the fear, the irrational selling, then it comes back to the fundamentals will now be the driver of price. So we've had a period where the fundamentals ceased to be the driver of price, and emotions got involved and computer programs got involved, but that's all past. And so now prices will be driven by the quality of the stock and by the value of the stock. So as I've been banging on about for forever, the focus needs to be on buying quality stocks and value, but only when the price is trending upwards. because quality stocks that are value can trend down and keep trending down for some time, even though that may not make a lot of sense. So make sure that you're applying those things. Buy the dips in an uptrend. So I'm not saying you buy you just buy at any old point. You want to buy an uptrend, but buy the dips in an uptrend. So that's the formula for consistently doing well in the stock market. So what you're doing is really trading off, trying to pick the bottom by increasing your chances of success by buying into an existing uptrend, or at least the proven start of a new uptrend. And that's how it's done. So for anyone that would like more information or would like to talk to me about the stock market and how I might be able to assist, there's my contact details, and we'll see what another week brings. But it certainly looks like we're entering a good period for the market through to Christmas. That's it for this week. Cheers.